crisis threatening the health of some major financial institutions. Does that put your bank deposits in jeopardy? Well, they're protected by the Federal Deposit Insurance Corporation, keeping a close eye on the health of the banks. And our Adam Shapira is with the head of the FDIC, Sheila Bair, and she was way ahead on this mortgage plan that was brokered by the Treasury. Adam, certainly something you're going to ask her about. Take it away.
We are going to talk about loan modification because Chairman Bair actually brought that issue up a long time before it became popular. But before we get there, there's a real basic question that a lot of people are asking as we keep hearing these different terms about capital and liquidity and banks in trouble. In the last half hour, we heard a guest say banks are in trouble. So if you're sitting at home and you're thinking, banks are in trouble, what does that mean to me and my deposit? Well, these are the questions we're now going to ask the one person who can answer them authoritatively, and that would be Sheila Bair, the head of the FDIC. And thank you for joining us on Fox Business. But when you look at banks, and today everyone's talking about Citibank, Citigroup, and this large injection of capital, $12.5 billion from foreigners. You know, prior to all of this, they were, quote, well-capitalized. They had a ratio well above what the FDIC would call well-capitalized, but it was trending down. Then we see them go out to borrow money. And if you're sitting at home, you're thinking, uh-oh, they're not well-capitalized anymore. Or are they still well-capitalized? And in general, are all banks still well-capitalized?
Well, I can't comment on any particular open institution. We have a strong policy about that. But I can comment generally about the current situation. We are in a very challenging credit environment. But banks went into this credit environment with very, very strong capital levels. Over 99% of our banks are what we consider well capitalized. As of the end of the third quarter of 2007, they held some $265 billion in addition to what they are required to hold to be well capitalized. Also, the Deposit Insurance Fund, the fund that we manage to insure deposits, is quite healthy. Your deposits are absolutely protected up to $100,000, our limit, $250,000 for retirement accounts. So people should not worry. The banking sector as a whole is strong. Banks are well capitalized, and the Deposit Insurance Fund is there for them.
So I want to very quickly, in simpleton terms, because that's what I would be accused of being, well capitalized means you got to have, according to the FDIC, 10% of your total risk-based assets capitalized.
That's right. You need to hold, there are three different requirements, actually. 10% of what we call both Tier 1 and Tier 2 capital against risk.
But the total?
10% or what we call a 5% leverage ratio, which is simply your capital to total assets.
Okay, so well, if I'm a well-capitalized bank, why am I running overseas to borrow money?
Well, because we encourage banks to maintain adequate cushions of capital. We are at a very challenging economic environment. A lot of the risk management tools that were being relied upon, such as economic modeling, have not proven to be as reliable as once thought they might be. So we maintain capital to absorb unexpected loss, and we are in somewhat of uncertain times, so we want to make sure that capital levels remain strong.
So what I hear you saying is that there's concern that maybe we would fall between that 8 to 10% level, which is between well-capitalized and adequately capitalized.
Well, it's still, again, overall, over 99% of all banks are well-capitalized. They're above that 10% level. I can't comment on individual institutions, but overall, banks are strongly capitalized, and as they have to absorb unexpected losses given this challenging environment, certainly it's a good thing that they go out and raise more capital because that protects us, that protects their solvency, and it helps them to keep lending to the economy.
We went almost 3 years without a bank failure in this country. Then we had 3 in 2007. 2008, will we have bank failures?
Well, we have 65 banks now on what we call our troubled bank list, which are those banks which the supervisors have identified are at heightened risk. Most of those banks, generally banks that are on our troubled bank list, most do not ultimately fail. That's because we put them on a special watch list and give them a lot of care and attention. So I think that those 65 banks represent about $18 billion in assets, which in the greater scheme of things, you're talking about an industry of $12.7 trillion in assets, $18.5 billion isn't a lot. Yes, we will have an uptick, but we're operating at very historically low levels. So yeah, sure, it's going to be a more challenging environment. There will be more failures. But again, we're operating from historically very low levels.
And that would be normal for the banking cycle to have failures?
Yeah, absolutely, absolutely. The 2.5 years we went through, it was unusual. That's not the norm.
What about this concept of too big to fail? How is that determined, and by what criteria are you too big to fail?
Well, I don't really think there is a bank that's too big to fail. I don't think, I think We supervise banks very carefully. We subject them to strong capital levels. So I don't really think there is a bank that's too big to fail. Any bank that runs into solvency problems that has to be closed, the FDIC is required to pursue a least cost resolution strategy, meaning that we need to minimize costs to our deposit insurance funds. There can be an exception to least cost resolution, but it's a very elaborate procedure. A supermajority of the FDIC board, a supermajority of the Federal Reserve Board, and the approval of the Treasury Secretary with the concurrence of the President, all that has to take place before we could violate least cost resolution. So we try to keep banks healthy so that doesn't happen, but I don't view any bank as too big to fail.
Very quickly, last question for you. Are you concerned with the influx of foreign investment into the capital funds of banks?
Well, I think those are at low levels. There are all those ownership interests are below 10%, and that's generally the rule that bank regulators look at. If you stay below that, there is a presumption that there is not effective control on the institution. So no, I think at those levels it's not problematic, and it is a good thing, again, that banks can raise capital because that continues to support credit activities and helps the economy.
All right. Dagan, our anchor in New York, would like to ask you a question.
Okay. Chairwoman Bair, I wanted to ask you, how quickly are these mortgage reworkings going in terms of the Treasury brokered plan? Are they happening fast enough to basically prevent the housing market from getting progressively worse here?
Well, we're picking up anecdotally that the loan modification activity is picking up. Now that we have this framework in place, we should be getting our first reports in a month or so. Part of the Treasury plan was to require very detailed reports from servicers participating in this. So, yes, anecdotally, we're hearing that the modification activity is picking up, and in a month or so, hopefully we'll have reports to back that up.
But the plan in place